Hello guys, welcome back to ESENtaxa. Andrea Papito here. In this specific video we are going to talk about how to have your company abroad while living in a different country, but this time we are going to deep dive on the reason why some countries accept that you can run your business with a company abroad, with an entity abroad, while resident in their own new legislation, while resident in this new country, tax resident in this new country, and why other countries they don't allow you to do so. Okay, so stick up to the end of this video and we are going to understand exactly which are the criteria behind it, which are the reasons behind it. And then of course, if you need to deep dive on this type of topics because you are one of the person with this specific situation, you can have a consultation with us. In the description below the video you will have our calendar link for 1 hour call, 2 hours call, tax simulation, and we can help you to understand if the relocation to a specific country makes sense, especially in Europe, and considering your structure, your tax structure, your company structure, your family situation, etc., etc. So, and you can also have more information typing our website www.ESENtaxa.com. Okay, now in this video I just want to tell you what I have learned through all our clients asking continuously the same classical questions. May I move to name of the country and keep my company abroad? Classical example. And in most of the cases, not in all cases, but in most of the cases, the person, it's one person, in most of the cases, sorry, the company is only one with one shareholder, which is also the administrator. So basically, it's the classical case, one company, so one person owning, classical example, one person owning 100% of the share of this company, but the person is tax resident in the country, in the new country that is moving to, for example, Belgium, Italy, Spain, France, whatever country in European Union or another part of the world. So tax resident, okay, here in this new country, while the company, the entity, is tax resident in another country, on the country from which he was coming from, or in a third country, okay? Because in the country from which he was living, it was possible to maintain this kind of structure. Right? So these are the situations that we are going to discuss in this video. Now, let's first discriminate the first situation. The situation when we have the substantial economical activity and when we don't have the substantial economical activity, okay? With the substantial economic activity, it doesn't matter where your company is incorporated. You can easily move wherever you want in the world and keep your company abroad. Why? Because it makes sense to have a company in that specific country. Classical example, I own a restaurant, I own a bar, I own a factory, I own a company, a leasing company or whatever thing. This is a substantial business that is that country, and you cannot incorporate a company in the new country you're moving to because it won't make sense. You cannot run the business. So this gives you a valid reason why in the new country which you are moving to, as only administrator and the only shareholder of this company, it gives you the reason to excuse you from possessing this company in your country of origin or in whatever third country, okay? While if you are in a situation of being one only person, only the administrator, and the business online, it's the business that runs because of you. It's around your person, so you're moving, you are the business actually. Of course, the new country of resident will consider that the place of effective management of this company, it's run for the majority of the year, of the majority of the tax year in the new country in which you're living, and then automatically they will qualify your company abroad as a local company. Okay, with all the fine interest, because the requalification comes after some investigation from the tax authorities. Okay, so I hope that at this point everything is clear, because now we are going to check which country makes this kind of act like this and which country don't act like this. Okay, so it's not just because type of business you have to take into account, but also the way the country you're moving to considers your company and the place of effective management of your company. So let's make this classification. Let me tell you how it works. So we have two categories of country. In general cases we have also exceptions, we have also hybrid situations, but in majority of the cases we can split the world into categories of country, one of which is called POM, place of effective management countries, which are those who considers the place of effective management of a company the real place in which the company must be taxed. And some other countries in which they consider the place of effective corporation, effective management, PEAM, and PEC, the place of effective corporation. So the place in which I have just incorporated my company. Okay, so these are the two main classifications. Actually, here it's the POEM. Sorry, I remember that the acronym is POEM. Place of effective, the other way around. POM, exactly. Place of effective management. Just to be precise with the acronym. So we have these two categories, and if you are moving to a country that applies the place of effective management as way of checking if your business must run or not, you have to make sure to check if your company has a substantial economical activity or it's on an online activity, because if it's in an online activity and your country in which you're moving to applies the POM criteria, of course you risk the situation of being seen your company requalified as a local one. Okay, while if you're moving in a country that doesn't consider the POM but considers just the place of effective corporation, it doesn't matter. You can keep your company abroad, even if it is an online business, or of course if it's a substantial business, it doesn't matter, but simply because you incorporated your company abroad, it's enough that the new country of resident will never requalify this company as a local one. Which are those countries that belong to this list? Classical example, tax havens countries and territorial tax system countries. Not in general cases, not all of them, but great part of territorial taxation country, they consider this one. But the majority of them are the tax haven countries, Cayman Island, Aruba, Virgin Islands, etc., etc. I mean, the classical tax havens, they are stick to the place of effective corporation, incorporation. Basically, are those countries that allows basically this kind of structure, regardless the type of activity. While, which are the countries that belongs to this list of the place of effective management? Then, well, the majority of the world countries, and of course the majority of the European countries, basically all of them, okay? So the majority of European country apply this one, and here are under the tax haven, classical tax haven country, okay? So these are the two main classifications, and of course in your specific case, if you need to check your specific situation, your specific case, you can have a consultation with us and we can check if your country is mostly in the place of effective management criteria checking or in the place of effective corporation. You can book a consultation with us and we can deep dive in this kind of topics. You can understand exactly the jurisdiction you're moving to, which one is the criteria used. But then now I'm going to give you the surprise, the cherry on top of the situation, because when it comes to the place of effective management, there is also a sub level of country, a sub list of country. What does it mean? It means that you have a sub classification, a sub list of country in which the POEM, the place of effective management, is automatically considered, automatically verified by default, okay? By default. And then the list of countries in which the place of effective management is still in place, but is not applied by default, okay? Not applied by default. What does it mean exactly? And here is the details. Here's the devil in the details. This is the devil. Here's the place we have to be. This is the point and the situation in which we have to be extremely careful. It means that you can keep your company abroad, even if it's an online business, and move in one of the European countries which apply the place of effective management, but we have to make sure that they don't apply it by default, but they are applied only if they have found a reasonable proof that you're really running a business from the new country. And that makes all the difference of the world, because if they apply it by default, just because you're tax resident, they will assume also your foreign company is a foreign one, and the proof is at your charge. You have to prove with some lawyer in court and whatever other procedure that the country gives you in place, gives you to make a kind of a controversy, to prove and pay somebody that helps you to prove the country that for real you're really running your business abroad. Okay? But if you are heading to a country that apply the policy of effective management principle but is not applied this one by default, then it makes all the difference, because it's on their chart. They have to see where you are, they have to see where you are while running your business abroad. And if you're for real, you're running your business abroad, so basically you're going abroad to run the business, and you live in a country of origin, and you live in a new country in which you just took their tax residency, even if your business is online, you have the chance to keep your company abroad without any problem with the new tax authority. You see? I can give you some examples. Let me go to Italy. It's the classical example of Italy. Italy applies the place of effective management principle, so you cannot have the company abroad unless it's a substantial economical reason behind it, because the Italian tax authority will think that you have open or you keep open the company abroad just because you want to avoid Italian taxes, and by default apply the place of effective management principle. So if you're an administrator of a company, or you possess the majority of the share of a foreign company and you become Italian tax resident, by default, maybe they're not going to catch you immediately, probably they won't going to catch you, but if they make some cross-check controls, by default they will consider your foreign company as an Italian one, and you have to prove that you are really running this business abroad, which is very difficult, especially if you're running an online business. You have to prove to be outside Italian territory to run an online business. Okay, it's quite complicated. While still in Italy, if you apply for the high net worth individual tax scheme, which allows to skip all your taxes on your foreign income in exchange of pay 200,000 euro. This is the new regime in 2025. If you apply for this specific regime for high net worth individual, Italy becomes a sort of territorial tax system countries, and it's explicitly written in the tax clarification that the place of effective management won't be applied anymore by default, but will be applied at the charge of the tax authorities. And then you can run for real your business abroad. Let's imagine you move to Italy, but you're running your business physically. You're going to San Marino Republic, you're going to Switzerland, you're just cross the border to run your online business. It's valid, because they have to prove, they have to find the proof. You see that you're running your business from Italy, but they don't have any proof because you for real you're doing this. So you're basically doing things legally, you are respecting the principle, you are running for real your business abroad, and they cannot requalify by default. They cannot give you at your charge the proof of the contrary. I hope I was clear. This is one of the important and most delicate informations and most detailed information that you might find online here in YouTube on tax international systems, and we help clients also on this subject, because this is the most common and important subject, because a lot of people want to move to a specific country in Europe and they are not aware of this kind of concept and the fact that they can simply or cannot simply bring with them their company abroad. Sometimes, based on the situation, you need to close it and reopen it in your country straight away, or you can keep it under certain conditions. After having seen the substantial economical situation, because for the substantial economical reasons, all this topic is dropped. It doesn't matter where the place of effective management, well, up to a certain point, and then this is something that you have to check together. But this is basically the criteria that must be followed whenever you are heading to a new country and you're bringing with you all your company abroad, and you want to keep your company exactly abroad. Okay? I hope I was clear. For anything else, you can also write us at info@ESENtaxa.com, and don't forget to subscribe to the channel, notification bell, and like button to be always updated whenever we release this kind of content. Thank you, see you to the next video.